Hi, I'm Mike mruger. I'm the managing partner at Greenbush Financial Group. When Congress passed the CARES Act on March 27th, they opened up some new distribution and loan options to individuals, employees, and small business owners that are going to be very valuable going forward. So anyone that has an IRA, 401k, or other type of employer-sponsored retirement plan, there are some new options available. One of the main ones is if you take a distribution from one of these accounts and you qualify, if you're under the age of 59 and a half, they are waiving that 10% early withdrawal penalty. Also, when you take distribution from retirement accounts, normally it's all taxed in the year the distribution happens. Now they're allowing you to spread it across multiple years to lessen the tax hit. And there's another feature that's then going to allow you to repay those distributed amounts to your retirement accounts and not have to pay tax at all. And in addition to that, if you're in a 401k, 403b, or a type of employer-sponsored plan that allows loans, before the limit was $50,000 and 50% of your vested balance, they now move the limit up to 100% of your vested balance, $100,000. And if you take the loan, you don't have to make payments for an entire year. Now, the reason why they're doing this is obviously to help support individuals, employees, and small business owners from a capital standpoint as they work their way through the coronavirus containment efforts. Individuals are waiting for tax checks from the IRS and to get back to work full time. And business owners are working through all the SBA loan programs, but that could take a few weeks. So what we're going to review are some strategies that you can use with these new distribution loan options to help bridge some of those capital gaps. So number one on the list is the waiver of that 10% early withdrawal penalty. So normally when you take distributions from retirement accounts and you're under the age of 59 and a half, you not only pay ordinary income tax, but you also pay that 10% early withdrawal penalty. For distributions that occur in 2020 from IRAs, 401ks, simple, SEPs, 403bs, any type of employer-sponsored plan, the first $100,000 that comes out of those accounts, if you qualify for one of four pieces of criteria, you will not have to pay that 10% early withdrawal penalty. And here are the four exceptions. So if you, your spouse, or dependent was diagnosed with COVID-19, this exception applies. Number two, you are unable to work due to a lack of childcare resulting from the coronavirus. Number three, you own a business that has closed or is operating under reduced hours due to COVID-19. And the last one, you have experienced adverse financial consequences as a result of being quarantined, furloughed, laid off, or having work hours reduced because of COVID-19. As you can see, very broad definition that we're expecting a lot of individuals will be able to qualify under. So now let's talk about the tax impact of these distributions. Even though you may be able to get the waiver of the 10% early withdrawal penalty, in a lot of cases, these distributions will still represent taxable income to you. However, within the CARES Act, they did put some new provisions that will allow individuals to either mitigate the tax hit or completely eliminate it altogether. So on the mitigation side, normally when you take a distribution from a retirement account, you have to pay tax on all of it in the year you take the distribution. But within the CARES Act, they are, by a default option, going to allow you to say you can split those distribution amounts a third between 2020, 2021, and 2022, even though you received all the money in 2020. So again, instead of taking it all in 1 year and being possibly subject to higher tax rates, they allow you to spread that out. Now you can voluntarily choose to have it all recognized in 2020. And some individuals will choose to do that because if I'm in a substantially lower income year because I was impacted adversely by the coronavirus, I might want to realize all that income in 2020 as opposed to waiting for the next 2 years when my income returns to its normal level. Now, I admittedly have no idea what they're gonna do from a tax reporting standpoint because normally when you take a distribution from a retirement account, at the end of the year, they issue a 1099-R tax form saying, this is what you have to report in your taxes. If I am splitting this between 3 different tax years, the custodian of your retirement account is going to have to know what election you made, and I'm guessing they will have to issue separate 1099-Rs for 2020, 2021, 2022, not only so you know what to report, but so the IRS can also track that you reported the income from a distribution you took a few years ago, but they haven't issued us a lot of guidance yet, so we have to stay tuned on that one. One of the nice features about the Act is it actually allows people the opportunity to repay the amounts that were previously distributed to their retirement accounts and avoid the tax hit altogether. So by taking the distribution, you avoided the 10% early withdrawal penalty, and as long as I put the amounts back in my retirement account within a 3-year period, I can also eliminate the tax hit. So it's almost like you gave yourself an interest-free loan for the amount of time that that money was out of your retirement account. And also the payback terms are flexible. You can either do it in a full lump sum, or you can make partial payments over the course of those 3 years. So I might take a $50,000 distribution in 2020, and then 2022, I can decide, oh, I'm just gonna put the $50,000 back into that account, and I wiped out the tax liability. Now let's say I decided in 2020 when I took the 50 grand to realize all the income tax. So I've kind of already paid it. What you would do is you would have to amend your 2020 tax return showing that you made the rollover back into your account in 2022, and then they would send you back the tax money. The piecemeal side, so it's not an all or nothing thing either. If I took 50,000 out and over the next 3 years, I'm able to put in 30,000 back in the account, that 30,000 will escape taxation, but the other 20,000 I didn't repay, I just had to pay ordinary income tax on it. So there's some flexibility involved with that. They are also waiving the 20% mandatory Fed tax withholding associated with distributions from employer-sponsored retirement plans. So normally when you take any type of cash distribution from an employer-sponsored plan, they have to withhold 20% before they send you the other 80%. They are waiving that for these corona-related distributions. So if you request 50,000, they're going to give you 50,000 from your retirement account. So let me pause and just kind of give you some examples for how we foresee individuals and small businesses using these strategies. So from the small business standpoint, a lot of our small business owners right now are clamoring to apply for the SBA Paycheck Protection Program or the Disaster Loan Program. And the problem with that is it takes time. It could be a few weeks before that capital actually makes it into the business. So some of our small business owners are saying that's great, but I'm gonna need some capital over the next few weeks to bridge the gap. This could be one of those options that they decide to elect. You know, the only thing you have to be careful of is if you're using your retirement account to fund the business and the business goes to zero, like that could obviously delay your retirement date beyond what you wanted it to be. And more so for the individual side, a lot of families are experiencing individual financial hardships. So being able to have access to some cash, even though it's from your retirement accounts, and some people might just be waiting for those IRS stimulus checks to arrive. And when they do, you might be able to use that money to repay some of the money that you took out of your retirement accounts. But overall, it's just trying to give some people some flexibility and to minimize the overall tax hit. So these distribution options that we're talking about, if you have an IRA, you're free and clear to qualify for these. However, if we're talking about distributions from a 401k or 403b account, plan sponsors have to know that you actually have to reach out to your TPA plan, your third-party administrator, and authorize them to make these distributions to your plan participants. It's not automatic. This is actually a voluntary distribution option that you have to opt into. Now, normally, most times you make changes to the plan, you have to file a plan amendment. But in this case, most TPAs are allowing you to, as long as the plan is amended by 2022, you can just say, hey, start offering these things, and we'll just retroactively amend the plan to allow these types of distributions to happen. So now let's switch gears over to that loan provision we mentioned earlier. So when you are in a 401k or 403b plan, your plan may allow loans. Now it's an optional feature, not all plans do allow these, but for plans that do, and for individuals that can show they've been impacted by that coronavirus, the same reasons that we talked about for a waiver of that 10% early withdrawal penalty, normally 401k loans are capped at the lesser of 50% of your vested balance or $50,000 in a 12-month period. The CARES Act opened up the ability to now raise those limits to say plan participants can take the lesser of 100% of their vested balance or $100,000. So they're opening up a larger loan amount that can come out to plan participants. In addition, you also have the option to defer those loan payments for up to 12 months after the loan is taken. So normally when you take a 401k loan, they hand you the loan check and those loan payments start at a payroll deduction effective immediately. You are gonna have the option to defer that. And you have the option to take these larger extended loans until the end of 2020. So while individuals will be using some of these strategies to kind of bridge this cash gap, I always do issue caution, of course, because anytime you're using retirement accounts to fund something other than retirement, there's risk. I mean, there's risk that when you take loans and distributions, that money's out of the market. So if all of a sudden the stock market rallies back, you are not going to be able to participate in that appreciation in your retirement accounts. Also, if you don't pay that money back from a distribution within a 3-year period, you are also going to have to prepare for a tax liability when you file your taxes. For the business owners, I already mentioned, if you use this money to fund the business and the business goes bankrupt, that's a big risk for you. And also for the big loans. So even though they're giving you an extension saying, hey, you can defer those loan payments for a year, remember after a year, those loan payments are going to begin. And if you took a really large loan, those deductions are going to be fairly large in your paycheck. So you have to be prepared for that. If you have any questions on any of these items, please feel free to reach out to us at moneysmartboard.com. Thank you.